Hello class, we're going to do our test review here using the material that was given. This will be continued for our test 3. So we're going to do 2017 and then the test will be 2018. So we want to get this correct. So this was what you were provided, this balance sheet at the end of 2016. So this is what we start with. These become our beginning balances in the T accounts to go forward in 2017. So cash, beginning balance would be 4,000. Accounts receivable, beginning balance would be 25,000. And of course, you've got to put it on the right side, the correct side, debit or credit, to make sure that it balances between all of them. Now, first, the next step, once we get those all entered into the T accounts, is we're going to look at these transactions. These are grouped into kind of two sections. We have the kind of regular transactions, really a review from from Accounting 101, and then we have the ones that are more unique to what we've learned in intermediate here. So going through these, we're going to sales are 280,000. We're going to debit accounts receivable and credit sales. Depreciation is going to be recorded with a debit depreciation expense, credit accumulated depreciation. Amortization, debit amortization expense. Now you could use depreciation and amortization together if you would like, and use that in one account to try to keep things a little simpler. And you can either credit accumulated amortization or the actually patent. Either is acceptable. Interest expense, debit interest expense, credit cash. We're going to find out there's some other interest on the convertible bonds a little later, but this is interest on other loans other than the bonds payable. Wages expense paid in cash, debit wages expense, credit cash. Insurance, we're going to pay 2,000, credit cash, debit insurance expense for 2,000, and then the other 3,000 comes from our prepaid insurance, credit, prepaid, debit, insurance expense. When we collect our money, we're going to debit cash and credit accounts receivable. When we pay our bills, we're going to debit accounts payable and credit cash. When we pay our income taxes payable, we're going to go up here, find out our income tax payable is $1,600, debit that and credit cash $1,600. Make a payment on the note, debit note payable and credit cash. And when we buy inventory, we're going to debit inventory and credit accounts payable. And our ending inventory is 56,000. That will allow us to, in our inventory T account, if you take the beginning balance, add the purchases, okay, and you know what the ending balance is, you can figure out how much you must have sold. That goes as a credit, 165,000, inventory into cost of goods sold. That's how we calculate cost of goods sold. Where did I put it? Oh, all the way over here. So, cost of goods sold. So it's hard to see all of it at once in the spreadsheet. All right. But you see that each of those transactions was recorded in the T account. Once you know what the journal entry is, you put the debits on the left and credits on the right so you can keep track of the balances. 1,000 stock options, fair value $4, vest over 4 years. So we know that these are the transactions that the account needs help with. Exercisable at $20, which is not important, except that we know that it's the same as the market value. But because we're going to use the fair value of $4,000 here over 4 years, that's $1,000 each year. So, journal entry we learned about stock option plans is we debit compensation expense, which is right here, compensation expense, and credit additional paid-in capital for $1,000. All right. 300 shares in open market for $20. So we're buying treasury stock. We learned that on using the cost method. We just debit treasury stock and credit cash. So we debit treasury stock for $6,000 because that's what we paid for it, and we credit cash. You have a lot of things in cash, so make sure you leave yourself the biggest room for that in your T accounts. Convertible bonds are new. Okay, $200,000 interest accrued during the year, but is not paid. So we're going to have to figure out both the issue of the bonds, okay, and the interest. So we're going to have a bonds payable, or if you wanted to sneak it in with your notes payable, I did here, kind of as to minimize how many accounts I have to show you, 200,000, and we're going to debit cash 200,000 for that issuance of bonds, and then we have the interest. So we calculate interest, but it's not for the whole year. It's only from May till until December. All right. Coupon rate is 3%, so we calculate it for the whole thing, and interest expense then, and interest payable would be calculated on that at $4,000. So 200,000 times 3% divided by 12 multiplied by 8 months that it had in place. July 1st, we leased equipment, which lease term is equal to its useful life. That means it's a capital lease, or a finance lease, I should say. It's $3,000 per year, bargain purchase at $500. So we're going to do a present value calculation on that. And that lease liability, okay, and lease asset, calculate right here the present value, 10 years, $3,500 at the end, okay, is $22,799.87. I rounded to $22,800 and put it in leased asset and credit lease liability. You want to keep the pennies, that's fine. All right, then when it's time to calculate depreciation, we're going to do that straight line on the income statement and makers for 7 years on the tax return. Okay, resold shares. Remember, we purchased 300 here. We're going to resell 100. That means we're going to credit treasury stock for the cost of that. If you think about it, the original cost $6,000. This is a third of it, so $2,000. However you want to think about that. But we collect $2,500. So there's your cash, and then you're going to have additional paid-in capital at $500. Where did I put my additional paid-in capital? There it is, $500. Lease the building with monthly payments for $2,500, 5 years. This is an operating lease, but we still have to figure out the present value. So here is our present value calculation for the 5 years, or the monthly payments, okay? And that's going to be debit to leased asset. Now I use the same, you could use a separate leased asset, and a lease liability of 126,991. Again, I rounded. And then we pay dividends equal to 50 cents per share. So we'll need to figure out how many shares are outstanding at that date. So we've done the journal entries for both. We're going to need to do the income statement. So we look to the amounts, all right, to do that. Before we get to that, this lease here is going to have two payments. We need to record both those payments. Okay, both those payments are for $2,500. So $2,500 cash, $2,500 in cash, and that's going to be a debit to lease expense. All right, given that it is a operating lease, and it's the same amount through the whole time, we can just make that straight line expense. So that's important on the income statement. So we come over here to the income statement. We pull in sales, cost of goods sold, depreciation. We took depreciation on that we were given. I put the amortization in here as well together. And the depreciation on our new asset. Okay, the new asset, not on the leased, not this leased asset, not the big one, this building, but this new equipment. Since it is our asset and it's a finance lease, we actually depreciate that. All right, calculating that depreciation using 10 years, and our balance 22,800, and we did it halfway through the year, so it's a half of the year depreciation, straight line. So that's where depreciation, that would have been a debit, depreciation expense, credit accumulated depreciation as well. Wages, insurance we talked about, lease expense, two payments of $2,500. Interest expense, we have interest on the that was given. Let's look at our interest expense. $8,400 was paid in cash, $4,000 accrued on the bonds, and then the $693 is interest on the finance lease for 1 month, because you would have had interest that you had not paid yet on that. So that would have been 1 month worth of interest added to the $4,000 plus the $8,400. Compensation expense, and now it's time to do a tax expense. Calling upon what we know about deferred income taxes, we do our two columns. We have our income before taxes that we just found, life insurance, so one permanent difference. Okay, get 46,767. Compensation expense is a temporary difference. Depreciation is the difference between makers, which is 0.1429. You can look up the makers table on Google or anything like that, and then take that difference between that and the 1140 that we used on the income statement, and our difference is 2118. So our taxable income on the tax return would be 45,649. And remember that then would be multiplied by 21% for the taxes payable journal entry, and then you have the tax asset for the compensation expense, the future deductible amount, and then you have the future taxable amount, depreciation, get 440. You take the 2118 times the 21%. So it's those three together equal tax expense. All right. Tax expense on this and the adjustments for these two. So that gets us through the income statement. All right. We'll come back in the second part and do the earnings per share and finish the financial statements.